Hello everyone, in previous videos I have valued the Magnificent 7 and the S&P 500 to see which individual stocks still look fairly valued. And in a similar trend I've decided to analyse these stocks as well. Some of these are the most popular stocks in the market, and using my discounted cash flow analysis and historical metrics I'm trying to see if these stocks are still offering fair value or are priced to perfection. If you get some out of this video, then feel free to give it a like and consider subscribing to the channel to help it grow. So to start it all off then, market cap for these businesses. Now one is exceedingly very high and quite a bit higher than all the others. Market cap is essentially just meaning that the size of the business based off all of their outstanding shares and the current value of the share price. And Apple stands out here as being particularly expensive, you could say, if you were trying to buy the entire business at $3.13 trillion. And then the others are varying different degrees. I would say FICO is probably sitting at one of the best prices if you were just looking from a basis of what could offer stability but good runway for growth into the future. But this is a very isolated metric and doesn't really tell us much about the businesses themselves other than how they're currently being valued. Next we have their revenue growth. Now we can see how quickly these businesses are growing on the top line, and for most of these businesses I've done their most recent quarter, so Q1 2025. The reason is because even though over the past 3 and 5 years these businesses may have been growing quicker or slower in some cases, there is sort of a nuance to how they're growing now, which I think is sort of insightful. So for here we have Uber growing 14% revenue, which is pretty slow compared to their 3 to 5 year average, but is actually still offering good growth compared to their valuation metrics. Netflix offering a similar rate. Apple growing the slowest at 4%. Hims growing the fastest at 111%, but some could say that this is growth that was sort of motivated by the GLP-1 drugs and is not really that stable going forward. We'll have to wait and see on that one. Costco offering 8%, which isn't that great compared to some of the valuations we're going to see for this business going forward. Palantir offering 39% growth, which is very fast and quite predictable based off their recurring revenue streams and stuff like that. And then FICO offering a 12% growth rate. Then we have their price to earnings, a very simple metric for sort of looking at the current share price compared to how much earnings the companies are achieving at the moment. Uber offers quite a good rate, around 17 here. This is actually something that looks quite good with their revenue growth. Netflix looking very expensive at 60 times price to earnings. Apple also looking very expensive at 32 times because we've got to look at these growth rates, especially in terms of revenue. Then we have Hims, which still looks very expensive, and I marked it up red here because it's looking at a 74 price to earnings despite this massive amount of revenue growth. Costco looking very expensive as well, maybe not so expensive as some others, at 56 price to earnings with only an 8% revenue growth rate. Then we have Palantir, which is just extraordinary. Even at the growth rates of this business, I don't think this is justifiable at 580, but I could be wrong, and I'm sure people with Palantir love will be hitting their keyboard right now. And of course we have FICO growing about 12% with a 67 price to earnings, which I've also marked up in the red. So both FICO, Palantir and Hims I would say all look particularly expensive in price to earnings, and then some of the others look expensive like Costco and Netflix as well. And we can use that price to earnings against EPS growth over the, say, past 5 years. Now, for some of these business, I've marked NA, mainly because it's actually very hard to get their current growth rates in terms of EPS for the past 5 years because they've not been that profitable for the past 5 years. Both Uber, Hims and Palantir have all been dipping down below zero in terms of EPS growth over the past 5 years. So it's actually quite hard to get a consistent growth rate. Ones that are consistent, Netflix has done very well and offers the best sort of level of EPS growth over the past 5 years. Obviously the next 5 years could be very different at 37% year over year. And then we have an 18% CAGR with the likes of Costco, still very impressive, and FICO 19%. That's not to say that Hims, Palantir and Uber are not growing their EPS very fast. If we was actually looking at their growth rates, we was talking over 100% in terms of EPS growth. More recently, Uber's growing theirs just below that 100%. Hims is still growing it well above that, and so is Palantir. So we'd have to see how these businesses are looking to grow, but at the moment it's too early doors to look at a historical EPS growth rate for these businesses. Now we can look at ratios that I actually use in my valuation models, the ones that I believe offer usually the best interpretation of the businesses and how they've been valued in the past. This is their price to free cash flow and price to operating cash flow, and I use this for the majority of the businesses that I look into. Now here, Uber actually looks one of the best. Here we have revenue growth 14%, price to earnings of 17, and a price to free cash flow of only 26, compared to a price to operating cash flow of 25. Now, this is when it gets a bit unfair for certain businesses. Palantir again is just through the roof at 244 times price to free cash flow. I don't think that's ever justifiable, and we'll see that in the valuation coming up. Costco is looking expensive, and Netflix as well, despite excellent EPS growth rates. But all of these look fairly pricey apart from Uber, in my opinion. Now we can adjust that for looking at their free cash flow and operating cash flow growth in 2025. So we can see how fast they're growing in this current year compared to their current price to free cash flow and operating cash flow. So Uber here growing very fast, over 66% free cash flow growth and 60% operating cash flow growth. This is still offering very good value, I would have said, if we are happy that Uber offers a very good moat as a business. Then we've got Netflix. Not too bad growth rates of 20%, beating out a lot of other businesses that are growing that fast, but the price to free cash flow massively lets it down here, and I would say this is looking on the more expensive side. Apple also looking on the expensive side when we look at free cash flow growth at around about 3%. This is pretty poor for a business like Apple, and it sort of shows that this slowdown is actually not really being reflected in the price, because the price is still over 32 times price to free cash flow, which is very high. Then we have Hims and Hers. Now this is another business that is growing revenues at 111% and growing free cash flow. I just left it in at 420%. The reality is that's growth rate that is never going to be replicatable because they are just coming up from zero. So I would say that even though they're growing their free cash flow very fast, I would not expect this rate to continue. But I just wanted to show that even though their price to free cash flow looks sort of arbitrary, quite expensive, their growth rates for free cash flow and operating cash flow is very high, and maybe that's why you could justify the share price right now. Then we've got Costco, which is sitting at 60 times price to free cash flow and only growing at 7% in terms of free cash flow in 2025. This is very, very high. I would have marked it up in red, but there is other ones that I think are a bit harsher to look at. Then we've got Palantir growing at 53% in free cash flow. This is very fast, very consistent free cash flow growth. What I thought was interesting was Palantir is growing at 240, is price to free cash flow of 244 times, growing at 53% year over year. And then we have Uber at 26 times price to free cash flow and growing free cash flows faster. I think that's quite interesting. And then you have the likes of Hims and Hers, which is blowing them out of the water. So not to say these businesses are better, because I don't think that they necessarily are. I think Palantir is an amazing business that I'd love to own. The valuation is what gets me every time, and I can't justify it. Then you've got the FICO, which I think still looks arbitrarily expensive, but their growth rates are still very impressive. Free cash flow growth of 36% is still on the higher end and is looking not too bad, but the price to free cash flow is again very high at well over 50. Next up we have analyst expectations for the businesses and my own interpretation of their historical metrics and DCF models over the past 5 years. So here we have analyst EPS growth rates in 2026. Here we see Apple is offering the least in terms of growth in 2026, which isn't really surprising given the previous metrics that we've already looked at for this business, and it is the slowest growing amongst all of these businesses. Then we have Hims and Hers, which is offering the fastest in terms of analyst estimates of EPS growth, but we did see that their price to earnings was particularly high, so that's something to bear in mind. Other ones that stand out to me, Palantir again, 21%, very fast growth rates in EPS, and I would say this is quite consistent given their business model. And then again, Uber, 18% expected growth rates, which is actually higher than other businesses that are graded a lot higher in terms of price to free cash flow, like the likes of FICO and Netflix. We get to analysts' expected growth rates for the businesses, and here we have some big standout ones. Again, Apple letting us down about with 9.2% in terms of growth rates. This is also sort of linked in with Costco, below 10%. These are expected as they're bigger businesses, and I would say they have one of the biggest moats out of all of these businesses. It's just unfortunate that their growth rates aren't really matching up their current price to free cash flows and price to earnings. And then we have the likes of Hims and Hers growing the fastest again here from analyst expectations. But then we have some others that are growing faster, again, Palantir and FICO. These are offering good growth rates despite maybe their EPS growth rates not being the highest compared to other businesses. Now we get to my own sort of analysis on these businesses. First off, I'll be looking at historical metrics of these businesses to see how they've been valued in the past, see if they're offering good value right now, just from looking at main sort of metrics. And then we'll look at the DCF valuations over the next 5 years, where we try to predict their free cash flow mainly, and sort of come to a conclusion about whether this business is offering a fair value and what the fair value is of the business. First off, we have Uber, which is actually looking pretty good. Its price to free cash flow, operating cash flow and price to earnings all look below their previous averages in the past. This could be because the business was growing a lot faster, but I would say that it's still offering fair value dependent upon this growth rate we're seeing in free cash flow, and we'll probably see that be reflected in the DCF. Then we have Netflix. Their price to free cash flow and operating cash flow look arbitrarily quite high compared to their growth rates, but they are below their averages for the past. This could be because Netflix was more of a speculative play for some individuals when they weren't producing that much free cash flow, and now they are. So I would say that this looks very high from an outward basis just looking at these metrics, but there could be more to it. Then we have Apple. It's not close to the price to free cash flow, operating cash flow high that we saw maybe about 3 months or so ago, where they were sitting at a 10-year high, but they're not far off of it. And really, if I'm honest, this free cash flow and price to operating cash flow for these businesses is pretty damn high. This business is pricing in a lot of free cash flow growth that they're just not seeing at the moment. So I would say that Apple looks quite expensive based off this metric. Then we look at historical metrics for the likes of Hims and Hers in terms of price to free cash flow and operating cash flow. I would say they look unpredictable, to say the least. This is a small business that's growing very rapidly, over 100% in top line revenue and over 400% in free cash flow. I don't think we're going to be able to predict it based off historical metrics because arbitrarily the price to free cash and operating cash look very high anyway. So I would say they are around averages over the past, say, about 3 to 4 years, which is all we've got for Hims, but they are unpredictable and I wouldn't really depend upon this going forward. Then we have Costco. Their price to free cash and operating cash flow is well above the average for the past for this business. This is a business that's growing slower than it ever has in previous. I think people just see it offering good sort of moat and consistency going forward, but I would say the growth rates don't really sort of match up with the current price to free cash flow and operating cash flow, and historically that looks overvalued as well. Palantir here, again, this is a very expensive business that I just can't even put into perspective. The price to free cash and operating cash flow is around close to about 2 times the average over the past, say, 4 years. And I think that's very expensive. That's why I've marked it up in red here. I think this business is seeing a lot of speculation despite very consistent fundamentals. So I think whilst the business is very rapidly growing, it's an amazing high quality business. I think it's going to grow well into the future. The business isn't a reflection on itself. It's more surrounding the valuation. I can't get on board with it. And I don't think this price to free cash flow is sustainable going forward. Then we have FICO, another one I've marked up in the red. Price to free cash and operating cash flow is well above the averages over the past, say, 10 years and look arbitrarily quite high compared to their growth rates for free cash flow. Now, the part that people are probably waiting for, let's do a DCF on the likes of these businesses, starting off with Uber. So this is how we're going to be laying it out. We're going to do a DCF calculator on each business independently, and I'll talk about the different things that I've factored in with this business, and you can choose to agree or disagree. Obviously, this is open to interpretation. This is not financial advice, and please feel free to do your own sort of research with this one. For free cash flow 5-year growth rates for the likes of Uber, I've said about 15%. I would say that's very possible for the business given their previous growth rates, and the likes of the future looks bright for this business if they can maintain their moat. I've said that they will only dilute by about 2%. This is allowing for stock-based compensation, but is also factoring the fact that the CEO is trying to focus on the value they offer to shareholders at the moment. So I don't think they're going to dilute as previously they have in the past. And their price to free cash flow, I've put 25 times. Others could put different here. Their average over the past has been higher, but I think that they were growing faster, and also in 5 years from now they're not going to be growing as fast as they currently are. And all told, that gives us a fair value sitting at $103 per share, which is around 7% upside from the current share price sitting at $96, and a CAGR of about 11.5%, which would be a market beating return. Next we get on to Netflix, and this is one where people may not agree with my growth rate and price to free cash flows and stuff like that. I try to be fair with all the businesses I look at. I try to look at the business themselves rather than any hype surrounding the stock or sort of love for the business that I or others may have, because I try to take my emotions out of it. That being said, I'm only human and I make mistakes as well. So if you don't agree, I'm sorry. You can do your own research. Maybe you're coming to a different conclusion than what I am. With Netflix, I think it looks very expensive. Over 70 price to free cash flow currently. Only growth rate over the past 5 years has been about 20%. This is on the higher end of price to free cash flow growth for most businesses, but for this share price looks very expensive. Currently, I've said for a 15% growth rate in terms of free cash flow over the next 5 years, which I think is doable for this business. I've allowed for a slight dilution of shares, as is their way over the past, say, 5 years, so I've kept the average there. And a price ratio for free cash flow that some may not agree with at 30 times 5 years from now. That's because their growth rate will slow down, I believe, potentially into the future, but I could be wrong there. Their free cash flow has exploded over the past couple of years. Now, all of that considered gives us a fair value that is well below the share price. Current share price is sitting at over $1,200, and the fair value at the moment is $660 that I've found in this DCF. This is almost nearly 50% pullback in the share price, and a CAGR over the next 5 years of minus 3%. Now, this may outperform that, I don't know, but that's my fair value for the stock, given these sort of growth rates. Now we get on to Apple, and this is one that I think for its current price to free cash flow compared to its growth rates over the past couple of years, less than 3%, I think this one is looking quite expensive just looking at those sort of valuations. But let's do a DCF and find out. Over the next 5 years, I've set a free cash flow growth rate of about 5%. I think that's an increase from the current sort of growth we're seeing. I'm accounting for service revenue there a little bit because that's growing very fast. But I do think that the dilution of shares will have less of an impact. I've left it at a 5-year average, but I think it will have... The share price is just becoming more expensive. So I think that the share impact of share buybacks is going to become less. Dividend growth rate about 5%, which doesn't really affect this DCF that much, and a price to ratio that is the same as it has been over the past 5 years. I'm allowing a lot for Apple's moat here, and I think I'm being more than fair. I think I'm being a bit more optimistic with this business than I would be with maybe others because of the high quality nature of the business itself. All of that sort of means that we get a fair value for this stock at $165 per share. That's well below the current share price of $211 and returns a CAGR about 4.7% over the next 5 years. Now we look at Hims and Hers, which is one I've been quite harsh with in this DCF because I really want to allow for the fact that this is a disrupting based company. It's not got a well-established moat. There could be things that affect their current growth rates in terms of free cash flow. So I've tried to allow for that in this DCF and give myself a margin of safety. Here I'm using operating cash flow because I think it is more of a metric to use for this business, although both the free cash flow and operating cash flow are growing very well. It's growing very fast, so I want to use this particular metric. In this particular case, I've chosen a 20% growth rate in operating cash flow. This is very, very conservative. This is not something I think is likely to materialise. I think it's going to be quite higher than this, but I want to be conservative in my estimates. The diluted share growth, I would say, is going to grow by about 1%. They do a little bit of dilution, not massive amounts. Their price to ratio, I would say, is going to be around 25. This is well below their current sort of levels, well below their previous 5 years, nearly half. And I would say that with the business being more established, this could go either way. It could be higher valued than this or less valued than this. If that all happens, then we get a current share price that is currently sitting sort of almost on its fair value. Fair value of about $49 compared to a $51 sort of stock and share price right now, and a CAGR of about 9% going forward. I would say that currently HIMS could well outperform this or underperform it. It's hard to say. It depends on how you think of the business going forward. If you think it's a massive innovator and is going to disrupt its field as it has in the previous, then it's going to outperform this DCF. But I want it to be fair with sort of things you might see in the business and with no surprises. I would try to get HIMS at a slightly different share price than it currently sits out personally. Next up, we have Costco, and this is an amazing high quality business that I wanted to be a bit more aggressive with its growth rate and price ratio to sort of see whether we could see this business maybe offering a good amount of value despite a premium. And this is again another business that we saw the growth rates were quite slow for. I've said 7% in terms of free cash flow growth rate over the next 5 years, mainly because in their previous Q1 2025 they grew around that, and I think that they could offer that sort of growth rate again, especially if they look at their subscription model for their membership and stuff like that. If they look to increase and sort of try to max out their pricing power, I think they could really accelerate that free cash flow growth. Then we've got a dilution of shares that is 0 because they keep it pretty consistent. Dividend growth sitting at about 13% and a price ratio of 30 times. Now I think that's quite high for a business growing at this growth rate. I would say that's a premium, but obviously some people may disagree. It's below their 5-year average. That means that the current share price is well above the current fair value we have for the stock based off this DCF. Fair value of $450, stock price of about $982, which is nearly half. In fact, it's over half. So a CAGR about minus 5% for the stock. However, I would say that Costco continues to outperform. The excellent quality business model is sort of shining through, and this is a business that is constantly sort of denied sort of the sort of average price ratios that we would expect. So whilst I think this DCF is fair, I wouldn't really rule out Costco as well going forward. Next up, we have Palantir, which is really a business that I just don't think I have the ability to sort of analyse, really. I'm sort of fair in my estimations of what I believe a business can do. And if I'm honest, I don't really see this one looking good on a DCF that I can perform. So if you're a Palantir holder, I'm sure you're well up in your position and you know more about the business than I do and can make your own assessment about the business. But if you want to see what sort of DCF calculations I've got for the business, then feel free to take a look. So here we have a metric growth rate of 50%. Now, I think 50% growth for free cash flow is not something I'd ever really like to put down for any of my businesses. Free cash flow growth for HIMS, I put down at 20%. That's because I want to be fair towards the business, maybe underperforming in certain areas. So I'm well aware of HIMS' faults and I want to allow for that. This is offering very little margin of safety for a business that's not even growing this fast. The business grew 39% free cash flow over the past, say, for 3 years, and I think that this could accelerate, but I don't know by how much. So I've tried to allow a little bit for that and give a sort of fair lick of the stick here. Dilution, they offer massive amounts of dilution in terms of SBC, and I just don't really know how that sort of levels out here, so I've kept it at the 5-year average just to be consistent. And then a price ratio of 50 times. This is 50 times price to free cash flow. It's really high. Like literally, I don't really think I've done that for any of the businesses going forward. Not Costco, not Apple, not Hims that's growing it over 400%. So I don't think that's really justifiable, and I wouldn't put that on a DCF because I wouldn't want to sort of underperform just because I got the wrong sort of ratio. But I'll put it in for Palantir just to show sort of what we're working with. And if we consider all of those really high expectations for the business, then we've got a fair value of $90 per share and a CAGR of about 0.3%. So it's sort of well below the fair value that we've got now, with the share price currently sitting at $143. But as I say, this isn't one I can maybe value the best. But I've done massively high growth rates, guys. These ratios and growth rates are something I wouldn't put in for almost any other business. And I think Palantir is an amazing business. So I think this is really asking a lot of the business. And I could see it underperforming from here going forward, if I'm honest. Then we have, finally but not least, FICO. This is an amazing business that I think has got an excellent monopoly. I've been a bit more conservative here because we've seen more recent news about FICO maybe sort of having encroaching sort of competitors with this, the likes of Equifax and stuff like that. Personally, I think the FICO will more likely come out on top, but they have sort of maxed out their pricing power, I believe, and we're starting to see that the sharks are sort of circling around FICO a little bit. So I could see that sort of government bodies and courts could maybe look at their monopoly a bit closer, a bit like they've done with maybe Google. In this particular case, I've set a free cash flow growth of about 15%. This is below their 5-year average, but that's because I think that they're maxed out their pricing power, if I'm honest. Their dilution shares growth rates, I've kept the consistent. They can buy back lots of shares here. I've said around about 3% to 4%. And then we've got a price ratio of 25 times. I think this is more sort of fair for the likes of how quickly the business is growing at around about 15% growth rates, but still allowing for a premium with the likes of their business. All told, this means that they are trading for a fair value of about $1,040 per share, with a current share price of $1,591 per share. So that's the sort of share price I'd look at FICO again, around about $1,000. I think that would be very good, but we may not see it because it's such a high quality business. And even though these growth rates, I would say, are fairly doable for the business, I would say that it's also possible that the business could underperform if their moat starts getting hit by the likes of new things we're seeing from the likes of courts and competitors. So there we go, that is my analysis of each and every company. Here are all the DCF valuations with their respective CAGRs in terms of growth rates. I want to be fair to some, like the likes of Palantir. I've said that a price to free cash flow and a growth rate of 50% going forward for the next 5 years is very hard to achieve, and I wouldn't want to price that in for any business, but it does look quite expensive even given those growth rates. Netflix was looking particularly expensive, as well as Costco, and I thought there was a few different ones that just didn't offer particularly good market beating returns. Hims, I think, could offer market beating returns well above their current growth rates, as I was quite sort of conservative with their growth estimates, but I think it's quite an unpredictable business model. And then we have Uber, which I would say is actually the king of this popular sort of stocks. Their growth rates, analyst growth rates, historical metrics and DCFs all look fairly good and market beating still, despite a recent run up in the share price that is well over 30%. So I would say this business has performed very well recently, could outperform going forward, and is the winner out of all of these. But what do you guys think? Do you like this sort of valuation and sort of framework? Let me know down below what other videos you might want to see, what sort of other businesses you'd like to see in this sort of format. Thanks for watching, and I'll catch you in the next one.